Happy Wednesday out there, Team 42. It's your skipper here, Darius Dale, to present our macro minute for Wednesday, October 11th, 2023. We'll start with our executive summary. So this morning, September PPI release out of the U.S. economy was confirming of our sticky inflation theme and suggests tomorrow's CPI data are likely to deliver a hawkish surprise as well. Compounding matters were hawkish inflation data from other sources. Number two, given the evolution of our quantitative risk management signals, namely our global macro risk matrix, it is critical investors receive far more good news than bad news this week. CPI, as I mentioned, is out tomorrow. Otherwise, the very nascent breakouts in cross-asset volatility and credit risk will begin to snowball themselves into a CTA deleveraging cross-asset crash. And number three, in the current risk-off top-down market regime, however long it may last, our primary focus is on helping Team 42 survive what could potentially morph into a phase two credit cycle downturn with the maximum amount of capital to invest when our model transitions to a risk-on regime near the lows. If we transition back to a risk-on regime sooner than that, we will go back to pounding the table on our year-end performance chase themes. Unless you're trading in a inefficient manner, there is little harm to being whipsawed by the same signals many thousands of investors across the world are employing to make sure they do not get blown up. Transitioning to our cross-asset performance here in my Bloomberg. So we'll start with the U.S. equity market, where U.S. equity market's up 3.1% on a week-over-week basis, being led higher by communication services and tech, up in the 4% range. We also got real estate up about 3.8% as well. Lagging, we got consumer staples down 0.6% week over week. In terms of equity factor performance, as I mentioned, SPY up 3.1%. The move higher in stocks is being led higher by growth, but you're starting to see a little bit less dispersion than we saw going back to a couple of days ago across the factors. In terms of geographic performance, S&P 500 up 3.1%. S&P 500 up 3.1%. Brazil leading the charge week over week, up 5%. India leading the lagging week over week, only up 1.4%. Outperformed during the drawdown, so naturally it's going to underperform in the bounce. Fixed income performance. The core ag up 1.3%. Fixed income is broadly being led higher by TLT and MBB, which is mortgage-backed securities, as well as senior loans. Senior loans as well. Not senior loans. My apologies. International Treasury bonds. So this is German bunds, Japanese government bonds, French oats, UK gilts, etc. All those kind of longer duration assets, including investment grade credit. Those things are all up about 2% on this move that we're seeing lower in rates. In terms of currency performance, we look at dollar still off a 4% on a week over week basis. That's given a lot of juice to some of the higher beta currencies like the Aussie dollar, like the Aussie dollar and the British pound up about 2%. You got a lower beta currency, the Swiss franc up about 2% as well there. And then in terms of the commodity performance, we're still flagging in terms of commodity performance. The DBC is down minus 1.2%. That's the broad index. Is being led to the downside by oil, up down about 4%. Base metals off about 2% or about 1% as well. And then kind of bucking the trend there up here, you got uranium up 2.3%. It's a higher beta expression. So anytime you see risk on, you're going to see things like uranium outperform. And then we also have precious metals up 1.9% on this dollar down move, very similar to what we were talking about with the higher beta currencies. And then lastly, crypto. Crypto is definitely not participating in the bounce here. Bitcoin is down 2% week over week, outperforming all over cryptocurrencies. What's leading to the downside? XRP is leading to the downside, followed by XAD, what's that? Cardano, and then things like Ethereum and Solana off about 4 to 5% as well. And then lastly, transitioning to my Loanbow dashboard. In terms of the ranges, trading ranges, you have the Shanghai Composite is still in a very narrow range, but still oversold in that narrow range. In terms, so it's not particularly actionable yet. In terms of that way, not particularly actionable unless that range starts to widen. And then lastly, S&P 500 will just leave you with some levels here on the SPY to get your day started. 42.27 is the lower end of that range there. We're getting close to the upper boundary there at 43 or 44.30. So we'll see how markets trade, but you get a little bit of uplift in that range. So if we can continue to see a signal like that, we need to see some good news fundamentally that could support the positive evolution of the 42 volatility adjusted momentum signals that are represented in our global macro risk matrix. If we do not start to see good news, then some of this negative evolution that we've accumulated in the last couple of months will start to snowball on itself. That's a guarantee. So we shall see. And anyway, we'll wrap it up there. Darius Dale presenting our macro minute for Wednesday, October 11th, 2023. Best of luck out there today. We'll catch you back here tomorrow. Cheers.